Hey yo, welcome. Good to see you. What's up, economics family? Welcome to the channel. Today we are going to be diving into something we like to call supply side economic policy. And no cap, this is literally one of those topics that does sound boring, but is actually low key running the entire economy. So grab your notes, grab your snacks, and let's get into it, because by the end of this video, you're going to be understanding that even better than your government understands how to fix potholes. All right, let's go. All right, so first things first, what even are supply side policies? These are the policies that the government puts in place designed to increase the productive capacity of our economy. Basically, the government's trying to help business produce more goods and services more efficiently. That's what they're trying to do. Think of it like this. The government is trying to help the economy. The government is trying to help business be more efficient. So if an economy was like a restaurant, supply side policies aren't about getting more customers through the door. That's demand. Instead, supply side policy is about upgrading the kitchen, training the chefs better, making sure that the restaurant can actually cook food faster, tastier, and cheaper. All right. So what are we talking about? We're talking about the main goal, shifting our long-run aggregate supply curve to the right. And when the long-run aggregate supply curve shifts to the right, that's when the economic vibes start hitting different. We're talking economic growth, lower inflation, more jobs. It's bussin'. I think I said that right. Two main types. Here we go. Two main types. Market-based policies. These are the ones where the government reduces its interference and lets the free market do its thing. So they're called market-based policies. Then there are ones called interventionist policies. They're the ones where the government actually gets involved. It tries to improve the economy's productivity, reaching its potential. It's intervening. So let's break them both down. Market-based policies. Here we go. All about the government saying, you know what? We're going to step back. We're going to let business and markets work their magic. Let's see. How do they do it? Number one, reducing income tax. Lower taxes, you keep more of your money, there's more incentive for you to work harder and longer, in theory. You are working smarter and harder, and maybe businesses pay less corporate tax as well. They can invest more in expansion, growing maybe the economy with regards to the level of output. What about reducing benefits? This is controversial take, incoming. The idea is if unemployment benefits get too high, some people might be like, why work when I can just chill? So reducing benefits supposedly encourages people to find jobs. We'll talk about why this is problematic later, don't worry. Maybe we could instead do deregulation. This is where we cut the red tape, we remove unnecessary rules for businesses, less paperwork. Businesses are able to then move faster, innovate, produce more. Like removing the speed limits from a business highway. Okay, that's maybe not the best analogy with regards to safety, but you get the idea. Or, here we go, number 4, privatization. Let's sell off government-owned businesses to the private companies, to the private sector. If private companies are more efficient, then maybe because they're motivated by profit, so competition then hits different when your job depends on it. So that's something we can look at too. Number 5, trade liberalization. Difficult to say. Reducing tariffs, trade barriers, so international competition will increase, forcing the domestic producers to level up or get left behind. So promoting competition. Here we go, here's example time. In the UK in the 1980s under Margaret Thatcher, I know, she went hard on these policies. She privatized British Telecom, British Gas, she reduced taxes, she deregulated the financial markets. Some people think she saved the economy. Others, they think, well, we may not necessarily go there, but economics sometimes can be a bit messy. All right. Interventionist policies. Let's have a look. Let's switch it up with interventionist policies. This is when the government actually says, hey, let's get involved. Number one, education and training. The government invests in schools, university, vocational training. Better educated workers should lead to higher productivity and the economy goes brrr. I don't know, that one confuses me. This is literally investing in human capital, making us smarter, better, more efficient, more productive. Sounds corporate, but is actually pretty important. What about number two? Healthcare improvements. Healthier workers, fewer sick days, more productivity, more output. It's giving them an apple a day, keeping GDP growing vibes. Plus, a healthy population are able to work longer and better, in theory. Let's think about number three, investment in infrastructure. No brainer. Let's build roads, railways, airports, invest in internet broadband speeds. Better infrastructure means businesses can transport goods faster and cheaper. Ever tried running a business when there's terrible Wi-Fi? Exactly. What about research and development for businesses? Let's give them subsidies. The government gives the money to the companies that are doing innovative research. This can lead to new technologies, new products, new industries. Today's weird science experiment is tomorrow's iPhone, you know? All right? Remember that. I don't know, remember that specifically, but remember this idea. Case study alert, Singapore, just across the border. Their economic transformation. You look at Singapore in the 1960s, they were low-key struggling, but the government went all in on interventionist policies. They invested heavily in education and they are now ranked really high globally. They built world-class infrastructure. If you've been to the airport, it's immaculate. Okay. They attracted foreign investment through tax incentives. They focused on skills training. The result was that Singapore went from a developing nation to one of the richest countries per GDP, per capita, in the world. Their glow-up was real. So, what do we want now? What advantages could there be? How about this one? Economic growth without inflation. If we're shifting the long-run aggregate supply curve, we're shifting productivity, you can have growth without prices going up. It's sustainable growth, the kind that should actually last. Improved competitiveness. Point number two. Better trained workers, more infrastructure, better technology. Your country's businesses are more able to compete internationally, giving it main character energy on the world stage. How about this one? Lower unemployment in the longer term, more productive capacity, more jobs. We're not talking temporary jobs, we're talking careers, opportunity, the whole vibe. Better living standards. Point number four. Economic growth should mean higher incomes, better services, and overall an improved quality of life. Everyone wins. How about this next one? Here we go. What about if we are tackling the root causes of any economic problems? Instead of just treating the symptoms, supply-side policies could actually fix underlying problems in the economy. Going to the gym instead of just posting gym selfies. You're actually putting in the work. Are there, however, disadvantages? That's what we're going to have a look at now. All right, so let's take a more serious tone. This is a big but, this one. Supply-side policies aren't perfect. I know. But let's keep it real about any disadvantages that there might be. The biggest one is the time lag. It's the biggest issue. The policies are going to take forever to work. Like years we're talking, sometimes decades. Education reform today might only show results 10, 20 years later when those kids have entered the workforce. Politicians want their results before the next election. So supply-side policies are like, lol, see you in 2040. I don't know I can pull that joke off. I don't. We'll see. How about this one? They're also expensive, right? They are very expensive. So infrastructure projects and education improvements, research and development all costs serious money. And where does the money come from? Well, usually taxes or government borrowing. Neither option slaps when you're trying to balance a budget. I don't know. I don't. Inequality issues. Market-based policies can actually increase inequality. Cutting taxes for the rich does not always trickle down to the poor. Spoiler alert, it actually usually doesn't trickle down at all. Reducing benefits can leave vulnerable people struggling. It's like not everyone wins. That's not what we really want. What about the results that we're going to get? Can we be certain about that? No, we can't. There's no guarantee these policies will work. You might spend billions of dollars on infrastructure and still not see the growth that you expect. The economy is complicated, bestie. I still don't know how I can pull these things off. I really don't. Opportunity cost. Money spent on supply side policies cannot therefore then be spent elsewhere. Maybe that money could have gone to healthcare. Maybe it could have gone to emergency services or climate initiatives. Every economic choice, every decision made has a trade-off. Case study, how about the not so great bit? Do you remember the UK in the 1980s? No? Anyone? No? Well, some businesses actually did well. Some businesses thrived, but there was also massive unemployment in former industrialized areas, increasing inequality, and a whole lot of communities that were left behind. The coal miners, in particular, would definitely not call it a vibe. What about environmental concerns? How about this one? Some supply-side policies like deregulation can lead to serious environmental damage if companies cut the corners, right? Economic growth at the expense of the planet. That's not very cash money of us. I don't understand that one either. So, in conclusion, all right, fam, let's wrap this up. Supply-side policies are all about increasing the economy's productive capacity, whether it's the government stepping back, market-based, or stepping up, intervention. The goal is still the same. We're trying to shift the long-run aggregate supply curve to the right and get sustainable economic growth. The pros, the long-run growth, lower inflation, more jobs, better living standards. The cons, takes ages, costs loads, might increase inequality, and isn't guaranteed to work. Now, for your exam, you need to remember, you must know the difference between market-based supply-side policies and interventionist policies. You should have case studies at the ready. Bring them to the front of the filing cabinet. Singapore, the UK, the 1980s, they are chef's kiss. Understand it's all about long-run aggregate supply and not short-run aggregate supply. Be balanced. Mention both the advantages and the disadvantages. And to tell you the truth, and honestly, in real life, most countries are going to be a mix of both types. Economics isn't about an ideology. It's about what actually works. And that's going to be different from time to time, but also different from country to country. All right, team, thank you very much. I hope this video helped you understand supply-side policies. Smash the like button. Please subscribe for more economic content that doesn't put you to sleep. Drop a comment below telling me which economic policy you'd like covered next. Until next time, keep your grades up. Keep those vibes immaculate. Peace.